A lot of people claim that the repeal of Glass Steagall in 1999 was a key event and a key cause of the financial crisis. So let's first try to understand what Glass Steagall is. Glass Steagall was a piece of financial regulation named after two senators, Glass and Steagall, that was passed in 1933 as part of a much wider regulatory regime change to really regulate, for the first time, massively regulate Wall Street and control what financial firms could do. And the idea behind Glass Steagall was to separate out the commercial banking activities of a bank and an investment banking activities of a bank. The idea is this: commercial banking activities are basically receiving deposits and issuing loans. Commercial banks like the Bank of Wells Fargo and the banks around the corner that you see, or little community banks, they're all kind of commercial banks. What they do is they take deposits from lots of people and they make loans to businesses and individuals. Investment bank is deemed to be riskier. It involves underwriting stock and bonds. It involves M&A activity, consulting, and to some extent trading on the bank's own accounts in financial markets. So in a sense, speculating. So it involves speculation in a variety of different markets. So the reason they wanted to separate these two out is the idea that, look, deposits are guaranteed by the government. We have the FDIC, the Federal Deposit Insurance Corporation, that basically guarantees deposit. Now, it used to be that they guaranteed only a very small amount. Today, they guarantee at least $250,000, and if you're in a big bank that's too big to fail, they basically have guaranteed all of your deposits. So the idea is, what we don't want to happen is that these deposits be then used for speculative activities on the investment banking side. So the cleanest and easiest way to do that is to chop them into two and say, commercial banks, all you can do, you get FDIC insurance, but you cannot use that money for anything but loans, as if loans are not risky and speculative. But put that aside, right? Investment banks, you don't get deposit insurance, so you can do all this other stuff, right? So you can speculate, you can be more risky. And that existed. So, for example, just to give you one example, J.P. Morgan, the famous J.P. Morgan, had a very large bank. It was a commercial bank and an investment bank. It did both activities. And it was split in 1933 into J.P. Morgan, which was the investment bank, and Morgan Stanley, which was Morgan Stanley is the investment bank, and J.P. Morgan is the commercial bank. Other way around. Anyway, it was split. J.P. Morgan was the commercial, and Morgan Stanley was the investment bank. What happened was that this division of labor just doesn't make any sense. So it's not anywhere clear that loans are less risky than some of the trading that investment banks do. Just look at many of the real estate crises that happened during the 80s and 90s, and where commercial banks were really, really in trouble. And the fact that they couldn't diversify across many, many areas really hurt them. And the investment banks did really, really well, and they were really not very volatile at all and didn't show any riskiness at all. So the whole question about whether this made any sense from a purely economic, even regulatory perspective was really questioned during the 80s and 90s, where it was really the commercial banking side that was viewed as more risky. Another element of this is that Glass-Steagall, that separation doesn't really exist in any other country. So European banks don't have it, Japanese banks don't have it, Canadian banks don't have it. So the idea was American banks were becoming less competitive with the rest of the world. So that's the background. Now, I'm putting aside the whole rights issue. Why is the government even getting into this issue? Why does the government telling bankers how to bank? And why is the FDIC insurance? The root cause here is the fact that the government guarantees deposits. If it didn't guarantee deposits, the excuse to regulate would go away. So put aside all of that. Just from a purely economic perspective, it was becoming clear that American banks couldn't compete internationally. And so there was a lot of pressure to repeal Glass-Steagall in the 1990s. And what happened is the first bank that really got into this was Citibank. The other separation, by the way, was also you couldn't have banking and insurance companies. And there are lots of other separations, by the way. For example, a bank cannot own more than, I think, 10% of a non-banking entity. So an industrial company. And an industrial company cannot own a bank. So there are tons and tons of regulations dictating who can own what and how much and so on, and they're clearly detrimental to the banking industry and to capitalism and to freedom in America today. Okay, so in 1999, they repealed elements of this. They didn't repeal all of Glass-Steagall. They didn't, for example, do away with deposit insurance, which is part of the original Glass-Steagall. All they said was, okay, we're doing away with this restriction about investment banks, commercial banks, and insurance company. You now can merge, and you can now run it all as one entity. We create a firewall between the funds that are part of deposit insurance and the investment banking business. So you cannot use deposit insurance money to speculate, right? But it can still be under one umbrella, one mother company. So in 1999, this was passed. Banks like Citibank clearly combined insurance and brokerage and everything together. But a lot of other banks didn't. Most banks, indeed, didn't take advantage. A lot of banks didn't take advantage of Glass-Steagall. Now, let's fast forward to the financial crisis. There's no evidence that this had anything to do with anything in the financial crisis. So, which banks got into trouble? Now, IndyMac, Washington Mutual, lots and lots of little community banks. Guess what those are? Those are all commercial banks. They have no underwriting of securities. They have no investing their own funds. They have no speculation. They do loans. Most of the ones who got into real distress were more like S&Ls. They did mortgages, right? So these are mortgage banks. So these are classical, traditional commercial banks, have nothing to do with Glass-Steagall. On the flip side of that, what other banks got into trouble? Well, Lehman Brothers, Bear Stearns, got into trouble, and a couple of other pure investment banks. They had no commercial banking arms. They had no deposit insurance. They had no, deposits and loans. They had nothing to do with commercial bank. They had nothing to do with Glass-Steagall. The only bank I can think of that really got into trouble and that was what we'd call a Glass Steagall Act bank, had both commercial and investment banking, is Citibank. Citibank got into trouble. But Citibank would have gotten into trouble anyway. Citibank is well known for a serial bankruptcy bank. It was bankrupt in the 80s. Because of Latin America debt, and it was bailed out. It was bankrupt in December of 1991. Citibank was bankrupt, as were many American banks, because of commercial real estate, and it was bankrupt in 2009, 2008, because of the mortgage crisis. In all three cases, Citibank was bailed out. So, of course, one could argue that when it was bailed out in the 80s, they didn't learn their lesson, and then they were bailed out in the 90s, and they didn't learn their lesson, so they keep repeating the same mistakes over and over again. Nothing to do with Glass-Steagall. So this notion that somehow, because banks were allowed to do both of these types of activities, somehow that created incentives, there's just no evidence, nothing, not a shred. And I've challenged many economists who've claimed this to present me with one piece of evidence to suggest how this happened, how this is related. But again, Washington Mutual, pure mortgage bank, pure commercial bank, no Glass-Steagall implications. Goldman Sachs, pure investment bank, no deposits, nothing. Now, what's kind of funny is that in order to be bailed out, in order to get access to the Fed, many of these investment banks today are technically commercial banks. They got a bank charter right in 2008, 2009. They were during the crisis. They flipped. But that was during the crisis that, again, had nothing to do with the causes of the crisis. So it's a myth. It's a myth established by the left. It's a myth established because most people don't even know what Glass-Steagall is. It's a myth that works because most people are suspicious of banking anyway. Most people resent bankers. They find it a little mystical that you make money out of money. They resent it. Read my article on money lending, where I describe this animosity towards bankers and towards money lending that goes way, way back, at least 2,000 years. So the left has capitalized on the ignorance and on the almost inherent suspicion of bankers in order to establish a complete and utter myth that has literally zero empirical evidence to support it.